Hello friends, how are you doing out there? I hope the markets are treating you extremely well. And we saw the markets rising last week in spite of the fact that I said I expect some headwinds based on the statistical data that I shared with you. Well, Monday and Tuesday did see the markets remaining under pressure, but Wednesday and Thursday, due to the SOPs being announced by the government of India, in specifically pertaining to the automobiles, telecom, and on Thursday for the banking space. Those triggered a kind of a feel-good factor in the markets, and the markets rallied higher. Friday, of course, was another ball game altogether. I'm going to discuss that in great detail. I would urge you to join me in this video till the fag end, because I've added one special segment only for this week where I'm going to cover the worries that are likely to encounter the market in the days ahead. So let's plunge right in, and coming up on your screen is the market roundup, and what you can see on the market roundup window is that the bank Nifty outperformed the Nifty 50 due to the bad bank announcement. This is expected to help ease the problems of the NPAs to a certain degree. Also, the Indian bond, sovereign bonds are to be included in the global bond indices in the calendar year 2022. Not too far, but definitely next year, not this year. And I'm going to discuss that in great detail and the implications of it for banks as well as the bank Nifty when we come to the 10-year benchmark bond yield segment. The dollar rose against the global basket of currencies, which pushed bullion prices lower. Oil and gas remained firm in spite of a firm dollar, which is an inflationary concern. And for the emerging market segment, a strong dollar is always a sign of caution. The 10-year benchmark bond yields rose by 1 basis point, which is neither here nor there. And the market-wide position limits, the MWPL chart, which comes on your screen, shows that traders were enhancing their exposures, which is of course routine up to the week before the expiry week itself. The basis charts, which is the premium enjoyed by the futures over the spot, shows the basis of the bank Nifty falling on a week-on-week basis because higher levels saw selling both from hedgers as well as short-term bulls who were unwinding their long positions. The Nifty, which was an inversion zone, which means the future was trading at a discount to cash, saw the price, the basis come up because bears covered some of their shorts on declines. Friends, let's now come to the volume chart, which is showing on your screen. I've taken the cumulative volumes of September, October, and November futures series. And this chart shows that the index futures volumes have hit a 20-period high, and the stock futures volumes have hit their highest level after the 26th of August 2021. According to me, that's a worry because the sharp rally in volumes which has come on the last trading day of the week, which is Friday, was also the day when the indices turned lower sharply. There was a big intraday drop. I see that as one red flag. Although, like last week, I'd say the red flags do not necessarily mean a bear market or a top or a reversal, but it's a sign of caution that you need to note. So moving forward, let's now come to the Impetus Chart, which is our exclusive in-house study, which you would have noticed in the last few weeks has been fairly accurate and helped us gauge the directions of the market very well. So the Impetus chart shows the bank Nifty impetus showing extremely high acceleration as compared to the Nifty. Now this acceleration can go high even when the index is falling. All it means is that the ongoing direction is gaining momentum. All right. So the bank nifty was rising and the impetus was also rising, which means that the bulls were very excited on the bank nifty as compared to the nifty 50, which is why the nifty continued to lose momentum even though it was at new highs. Ideally, I would have wanted the nifty impetus also to rise as fast as the bank nifty, which would have told me that the bulls are on a much stronger wicket. Nevertheless, things can improve next week if the impetus rises. So let's keep a keen eye on this. Now, let's now go to the footprint of the four types of players in the markets, which I've been sharing with you since the last couple of months. The FIIs continue to unwind their stock futures long positions, which are now at 2,68,053 lots as against previous week's 3,05,500 lots. Their index longs rose to 63,220 lots against last week's 45,205 lots. The DIIs, the domestic investment institutions, cut their stock short positions to 12,49,204 lots, which last week was 12,83,702 lots. As far as their index futures shorts are concerned, they rose to 94,812 lots short from a previous week of 86,121 lots short. Now let's see what the prop traders did. They kept reducing their stock futures long positions on a week-on-week basis, which are now at 1,31,732 lots, and last week it was 1,51,130 lots. Their index shorts were lower because they covered their shorts, and they are now at a short position of 10,186 lots, which last week was 18,588 lots short. The retail guys, now let's see what the retail guys are doing because they've been powering the rallies so far. The retail guys cut their index futures longs sharply to 41,778 lots, which last week was 59,504 lots. Their stock long positions continued to rise at 8,49,422 lots, which last week was 8,27,072 lots. Now, the retail traders' figures need constant watching because they are the ones who've been powering the markets higher for now. Friends, let's now go to the 10-year benchmark bond yields, and there's a very interesting story unfolding here. It's showing signs of being range-bound last week. The announcement that the Indian sovereign bonds will be included in the global bond indices is very welcome and a very, very big news. As a matter of fact, I've done a very detailed video on Equity Masters YouTube channel. I have in the description below this video provided a hyperlink to that video with hard numbers and my logic behind why this announcement is bigger than GST, it's bigger than the PSU disinvestment, and it's bigger than the asset monetization announcement of late. And over a 10-year period, if things go right, you can see a sea change in the foreign inflows, dollar inflows in the Indian bond markets. So suffice it to say now that I'm going to give you a good deal of details as to why I think it's bullish, but the in-depth details are in Equity Masters YouTube channel, which below this video in the description segment there is a hyperlink to. So now this basically revives the bank's sentiment very, very sharply. And the logical reason behind this is that the banks are normally the biggest bond buyers of the government of India. They can now save their money for their usual business of lending, while the FIIs do the investing in the bond market. Now, that also takes care of the cash flow needs of the government. And like I said, this inclusion of Indian bonds in the global bond indices will start from 2022. So it's early days yet. The Bank Nifty, of course, celebrated the move upfront. And what with the bad bank and bond listing, there seems to be some cheer in the Bank Nifty and the banking stock space. I think you should watch the markets with a 360-degree view, because unless you know the cause of what's happening, it becomes very difficult for you to understand how long the impact would last of that particular trigger. So here I've shared with you the cause and the effect of the bond market on the Bank Nifty. Friends, I move on to the Dixie, the US dollar index, which is the US currency benchmark, which rallied on 3 out of 5 trading sessions last week. As you can see on your chart on screen, the Chinese credit crisis, which is unfolding, and I'm going to talk about this at the fag end of this video in a special segment. Don't go away. As the Chinese credit crisis got more and more severe, there was a flight to safety, which saw traders turning to the dollar as a safe haven. Now, the price, as you can see on your daily chart on screen, is above its 25-day exponential moving average, which means even the short-term outlook is positive for now. The 93.5 levels, which I've been advocating as a near-term resistance to watch, remains inviolate. Now, let's turn to the weekly chart, which shows a fortnight of gains, and that too from the support area of the 25-week exponential moving average, which tells me that the medium-term outlook also remains positive till this moving average holds as a support. Any rally in the dollar is negative for emerging markets because they are invariably import dependent and they nurse overseas debt. Now that drives inflation higher, and last week I advocated a range between 93.60 on the upside and 91.60 on the downside, which held perfectly well. In the coming week, I expect an estimated, I stress upon the word estimated, range between 94.20 on the upside and 92.15 on the downside. Watch this index very keenly in the coming week, because it will basically determine the levels of commodities, currencies, equities, and even global bond markets. Friends, I now turn to the Bank Nifty, which outperformed the Nifty 50 as we saw earlier. And remember, the impetus had risen sharply on this index. This index rose on 4 out of 5 trading sessions and gained more than the Nifty in relative comparison. I had put forward my hypothesis a couple of weeks earlier in my video that the Bank Nifty could hit new highs provided the bulls held the index above the 36,500 mark and kept above this level sustainably. That hypothesis was validated by the market action. Now, the price on the daily chart stays above the 25-day exponential moving average, which means the short-term trend also remains positive for now. The last day, which was a Friday, shows a long-legged doji, which is a sign of some selling, although the bulls pulled the price higher ultimately towards the fag end of the trading session. Now the bull camp will have to keep pushing the price higher, failing which profit sales in the near term might trigger and weaken the sentiment. Let's now take a look at the weekly chart, which comes on your screen. The index shows a big bullish candle, which has put the bulls back in the driver's seat. Now, the 36,200 level must be defended at all costs in case of declines in the coming week. And if the bulls are to maintain the momentum, this 36,200 level is their litmus test. In the week before last, the index was at number 1 on the most volatile counters list. Last week, it fell 1 notch to number 2 because individual stock volatility jumped sharply, particularly on Friday, remember. Last week, I advocated a range between 38,050 on the upside and 35,325 on the downside, which was overcome very, very marginally. As a matter of fact, to the extent of 63 points, because the Bank Nifty saw 38,113 as a high, intra-week high. Now, the coming week is likely to see an estimated, I repeat the word estimated here, range between 39,200 on the upside and 36,425 on the downside. Friends, I would suggest you trade light and also stay with me till the fag end of this video for the special segment that I have recorded here. Let's now go to the Nifty 50, which underperformed the Bank Nifty on a relative comparative basis, and it rose on 3 trading sessions out of 5 last week. Note the impetus of the Nifty was lower compared to the Bank Nifty, so it comes as no surprise that the bulls were really a little hesitant to offer support on this counter. Friday's red candle is a noticeably sizable one, and as a matter of fact, this candle was the most prominent candle of the week gone by. Note the index volumes chart that we saw earlier showed the index volume spiking to a period high. It is this red candle which triggered the big traded volumes. Now this is the second red flag for me this week. Remember, the red flag does not necessarily mean bearishness, but it's a sign of caution. The price is comfortably above its 25-day exponential moving average, which means the short-term outlook also remains positive for now. I would watch out for the 17,200 level as a support on dips in the absolute near term. As long as that level holds, the bulls are still in command. Let's now take a look at the weekly chart, which shows a bullish candle, which is not really a perfect inverted hammer because the upper shadow is small. This was, of course, the shadow is due to the sell-off on Friday. Do remember, Friday was a reversal day. If the Nifty breaks out above the weekly high of 17,793, which was made last week, and stays above it, all is well and the bull is alive and kicking. The price is staying above its 25-week exponential moving average, so my medium-term outlook also remains positive. In the week before last, this index was at number 12 on the most volatile list, but it fell to number 17 because stock volatility rose faster than the volatility on this index. Last week, I advocated a range between 17,775 on the upside and 16,900 on the downside, which was overcome by a mere 18 points. How's that for precision? Now, the Bank Nifty was overcome by 63 points, which on a base of 37,000 points is actually nothing. And the Nifty 50 was exceeded by 18 points, which on a base of 17,000 is also insignificant. So this is thanks to our in-house statistical model, IBEX, which is being developed very proactively. So the coming week is likely to see an estimated, I stress upon the word estimated, range between 18,050 on the upside and 17,175 on the downside. Friends, I would suggest you continue to trade light because the volatility is likely to shoot up anytime, and enforce your stop losses very, very diligently and safeguard your capital in the coming week. Friends, now the Nifty and the Bank Nifty segment done, I come to the most popular segment of our video, wherein I give you 5 stocks that are low beta, low impetus, where you take big exposure, wait for small price moves to make your money, and 5 stocks that are high beta, high impetus, where you take small exposure, wait for big price moves. Why the difference? Because different traders, different mindsets, and different techniques, therefore. So let's now start with the high beta, high impetus stock list, which is led by Indus Bank at number 1, Z at number 2, no surprises there. Number 3, NTPC. Number 4, GAIL. Number 5, ITC. ITC also suddenly sprang back to life, so it appears in this list now. Now for 5 stocks which are low beta, low impetus stocks, led by Shree Cements at number 1, number 2, Mahindra and Mahindra, number 3, Havells India, number 4, Asian Paints, and number 5, UBL. Friends, this hierarchy can change from day to day, and therefore this is due to the volatility intraday that can change in a counter without any warning, which is why I suggest you connect with me on social media, wherein I update a lot of market related statistics every day at the end of the day, which should help you. These are very simple numbers, very simple graphics, etc., which a high school student can understand at the drop of a hat. So, friends, now I come to the segment wherein I promised you there would be an explanation and some detailed thought into what is happening in China. If you remember, there were a couple of videos that I recorded. The first one was on 14th of April, and it was specifically about Huarong and Archegos Capital. At that point in time, Huarong, which is an asset reconstruction company in China, was undergoing distress. It was not paying its loans, it was not able to pay back its debt, and there were delays in sending out checks. We are now joined in the long list of Chinese companies which are unable to pay their debts by Evergrande, which is simply the world's largest indebted real estate developing company. The Chinese are not forthcoming in sharing data with us as fast as they should, and let's face it, the data that does come out leaves some credibility issues. So whether they are watering down the numbers, whether they are giving us bad news in bits and pieces, we do not know, and that is what is raising the fears in the market, which is what was partly responsible for the market falling on Friday. All right. Now, I have done a video, like I said, on 14th April. Thereafter, I followed up that was a special video on Huarong and Archegos. By the way, the link to that video is both, if you're watching it on the computer, on top here on the screen, and also in the description below this video. There are hyperlinks to that video. A weekly market outlook video on 31st of July was also recorded, warning you that the Chinese markets could actually drag the Asian markets lower if things really turned bad. And also there is a third video which I recorded about financial crises in the markets and how the financial markets behave. So now that you're seeing a lot of stuff being written about in the social media, in the mainstream media, talks are going on as to how this is China's Lehman moment. Remember Lehman Brothers crisis in America? It brought the stock market down, triggered off a global financial crisis. So is this going to be as big as the US Lehman Brothers drawdown? You see, at this point in time, if we were to assume that the Chinese numbers of $300 billion of Evergrande are correct, Huarong and Soho China, which is Soho China is another real estate company which they actually tried to sell off, but the sell-off didn't really happen, and when the foreign buyer pulled off, Soho China's stocks fell 40% very, very sharply in a short period of time. So these are three companies which my gut feel is might just reach in terms of the cascading multiplier effect to maybe $800 billion, maybe even $1 trillion. So this is something that is worrying the markets. And which is why I suggest that you trade very carefully, keeping stop losses on your long positions. I remember a tribal saying that I had heard many years ago, Sar Salamat to Pagdi Hazar, which very simply means if your head is intact, you can wear 1,000 different turbans. So for now, in the absolute near term, I think we should focus on staying safe. Of course, trading does not stop. Continue to trade, but just trade light. Maintain your stop losses. And at the first sign of trouble, if you see a sharp sell-off coming off, run. There is no shame. We as traders are supposed to protect capital. And as the James Bond movie says, live today to die another day. So this is the sum and substance. Do check out these videos. The hyperlinks are there in the description below this video itself. There are 3 of them. The Huarong and Archegos Capital, Chinese markets dragging down the indices, and the lessons from past global financial crises. Friends, I bid goodbye to you in this video, not before reminding you to click like on this video if you agree with what you saw. Subscribe to my YouTube channel if you haven't already done so. And in the comment section, do keep the line of communication open. Tell me what you think about this video. Help me reach out, more importantly, to fellow like-minded investors and traders who are savvy, data-dependent, logic-dependent traders by referring my video to your family and friends. And at the end of this video are my contact coordinates. Do connect with me on social media. I will update market data every single day late in the evening, which will help you stay ahead of the markets, just as I have been keeping you ahead of the markets in these videos. I thank you for your patience for watching this video, and I wish you have a very, very profitable week ahead till we meet again in my next video. This is Vijay Bambwani signing off for now. Have a very, very profitable week. Thank you. Bye-bye.